Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning and a warm welcome to Money Talk. This is Peter Lewis with your daily update on the business and finance news from across Asia. This podcast is sponsored by Surfin Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. And thank you for making us one of the most listened to financial podcasts in Hong Kong. In today's business and finance headlines, the Fed believes more interest rate increases are needed to combat high inflation in the US economy, but at a slower pace. Fed officials at their June meeting decided to hold off on raising interest rates, opting for a pause to assess the impact of 10 previous hikes. But almost all officials who participated at that meeting said additional increases in the Fed's benchmark interest rate would be appropriate. The Eurozone economy ground to a halt at the end of the second quarter, ending a robust sequence of services-led growth seen since the beginning of the year. While services business activity growth continued, it slowed to a 5-month low in June. Gains in output in the services economy were counteracted by a sharp and accelerated decrease in factory production volumes during June. China's services sector activity expanded more slowly than expected in June, a survey of smaller private firms showed on Wednesday. The Caixin China General Services PMI fell to 53.9 in June from 57.1 in May, well below the median forecast of 56.2 among economists. It was the 6th straight month of expansion in services activity, but the softest pace since January as demand moderated. And Hong Kong's private sector remained in expansion in June, but grew at the weakest pace in 6 months, according to the latest PMI data from S&P Global. Its Hong Kong PMI declined to 50.3 in June from 50.6 in May, and below forecasts amid a softer rise in new orders due to weakened demand. On today's programme, I'm joined by Andrew Freris, the CEO of Ecognosis Advisory, and Michelle Lam, Greater China Economist at Societe Generale Corporate and Investment Banking. We're also going to take a look at how Hong Kong's mandatory Provident funds have performed in the first half of the year with Francis Chung, Executive Chairman of MPF Ratings. And if you want to see my daily newsletter, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street, US stocks fell Wednesday as markets reopened after the 4th of July holiday and traders digested the latest Federal Reserve meeting minutes for insights into the Fed's thinking on monetary policy. The S&P 500 fell 0.2% to 4,447. The Dow lost 130 points, or 0.4%, to close at 34,289. Both the Dow and the S&P 500 snapped 3-day winning streaks. The Nasdaq Composite slipped 0.2% to end at 13,792. Treasury yields rose Wednesday as investors absorbed the release of the Federal Reserve's latest meeting minutes. The benchmark 10-year Treasury yield rose 7 basis points to 3.93%. Stocks in Asia Pacific fell across the board on Wednesday as the latest PMI surveys showed activity in the services sector in China and Japan growing at a slower pace last month. Australia's ASX 200 sank 0.4%. In Japan, the Nikkei 225 dropped 0.3%. South Korea's Kospi, meanwhile, lost 0.6%. India bucked the downward trend elsewhere in the region, with the Nifty 50 rising just under 0.1% to hit a record high for the 5th consecutive session. Greater China markets were lower. In Hong Kong, the Hang Seng Index tumbled 305 points, or 1.6%, to 19,110. And that trend looks set to continue at the open this morning. Futures markets are pointing to a loss of 100 points, that's 0.5%. On the mainland, the Shanghai Composite edged 0.7% lower to 3,223. There was sharp weakness in the yuan, with rising export tensions adding to the weak PMI data. In Shanghai, the Chinese currency closed 0.4% lower at 7.2465 renminbi. Offshore yuan is at 7.2625. The yuan has slid 5% against the US dollar so far this year and is heading towards a 15-year low. And you can get more details on the latest market movements, which you'll find in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
It's time to welcome our Thursday morning guests, and I'm joined this morning, as every Thursday morning, Andrew Freris, the CEO of Ecognosis Advisory. Morning to you, Andrew.
Good morning.
And also joining us is Michelle Lam, who is Greater China Economist at Societe Generale Corporate and Investment Banking. Good morning, Michelle.
Good morning, Peter.
China's services sector activity expanded more slowly than expected in June. A survey of smaller private firms showed on Wednesday. The Caixin China General Services PMI fell to 53.9 in June from 57.1 in May, which is well below the median forecast of 56.2 among economists. It was the sixth straight month of expansion in services activity, but the softest pace since January as demand moderated. New orders eased to a 6-month low, and new export business grew solidly, but the rate of increase edged down to the softest since January. Meanwhile, employment climbed for the 5th consecutive month, with the speed of job creation being the strongest in 3 months. On inflation, input prices rose solidly due to elevated staffing costs and higher prices for raw materials. Meanwhile, output costs increased only slightly amid the strong competition. And finally, business sentiment improved for the first time in 5 months amid hopes of stronger economic conditions and greater amounts of new work to support growth. And Michelle, do you want to kick off there? There's quite a lot of information, isn't there, in the PMI and the services sector? What did you glean from it about the economy on the mainland?
So I think a decline in the services PMI is expected and consistent with what we saw in the official data released earlier. And it's just reasonable to expect some slowing momentum given that the reopening momentum we've got already quite a strong recovery in the first quarter, so there's less juice left for the services to climb further back to the pre-COVID levels. And I think what is slightly worrying is that if you look at the tourism spending data for the Dragon Boat Festival, it seems that it's deteriorated a bit compared to what we saw in May. So tourism spending actually fell to below the 2019 levels, which to me suggests that maybe the people are still keen to travel, but the willingness to spend seems to be still a bit softer than what I would expect.
Andrew, what are your thoughts?
My thought is I prefer to take both the official and the unofficial PMI indexes together. First looking at the manufacturing and then looking at the service sector, particularly in the Caixin. And there is one thing, if I put the charts up, I put them about 6 feet away from my eyes, I squint and I look at them, I would say they're going precisely nowhere. The fact that 6 months of over 50 is there, it is literally all over the place. It goes up, it goes down, it goes suddenly significantly up, and then it goes suddenly significantly down. For me, if it shows you anything, it shows complete, I wouldn't say inability. People, remember, the MPI index is asking it's calculating the percentage of people thinking that it's going to be better and the percentage of people saying that it's going to be not be better. Okay, if more than 50% say it's going to be better, then the index over 50. Very simple as that. Of course, we want it as much over 50 as possible. So the answer is I look at these figures, something which is deeply worrying, and that is in terms of expectation, we are having a quagmire where we are stuck in the mud. We are not going anywhere fast.
I've heard the Chinese economy being described as being in a balance sheet recession. In other words, people don't want to spend, they want to pay down debts. That's true of both businesses and companies. And as a result, that's slowing the economy. Is that true? Is that the right term to describe where the Chinese economy is?
I prefer to say that the consumption sector, before I start brackets, net export growth is not a driver of the Chinese economy. So leave that aside, please. Okay, it adds very little. Let's concentrate on investment and consumption. The consumers and the producers are still punch drunk from 3 years of incredible experience. And also, don't forget, the recovery came completely unexpectedly. Okay, in December, suddenly everything was lifted with no explanation. Okay, and apparently we are back to the races. No, we're not. Okay, and one of the important things for me that has been left completely unobserved is it involves the symptoms of the long COVID. Anybody that has got COVID, okay, the 80% of the people that had COVID continue to suffer from symptoms of COVID that are really debilitating, but they don't kill them. You know, in China, literally hundreds of millions of people carry on every day working, not feeling well. There is no way I could quantify that. Neither there is any way I could prove that this explains why the economy is so subdued and why consumers are unwilling to make big expenditure moves. Okay, but you know, if I wanted to blame something, I would be delighted to blame the long COVID. And I'm working very hard to find a quantitative relationship between the two. I started with China because China was a classical example where there was an abrupt change. Okay, and then effectively, not a great deal happened.
Michelle?
Hong Kong also is exactly the same, but it's a smaller case. Okay.
Michelle, what do you think about that? Do you think China, this is long COVID, that, people, workers are still suffering from COVID a couple of years ago, and maybe that's having an impact on their work and on their ability to get out and go and enjoy life and spend a bit more?
I think that is certainly the case for some of the service sectors firms that have suffered from weak revenue over the last couple of years, and they're still very cautious about expanding the business and hiring people. And I think that's also the result that what you see in the labor market, for example, the young people, a lot of them actually would normally be employed in the retail, catering, accommodation sectors. But these sectors, I think they're just still adjusting. They're still recovering from the long COVID, the COVID scarring impact. So I think to some extent it's true. But I think when it comes to the question of whether China is in a balance sheet recession, I think I think it's more of a risk. Right now, I think if you look at the household balance sheets, I think if you look at the debt ratio, actually the debt to GDP has been stabilizing at 60% of GDP since 2022. So I think there are stories that some households, they're probably trying to repay the mortgage debts because the house prices are not going up any further. So some of the households, I think, are doing that. But I think as the household sector overall, I think there is a risk of a balance sheet recession. But I think right now, I think we're still not there yet. So I think a lot of things would depend whether the house prices would continue to decline. And if that's the case, I think the risk is going higher.
It would
about some of the construction firms, for example. I mean, under the free red line campaigns that started in 2020, then certainly these real estate firms are in a balance sheet recession because the leverage ratio was too high to start with.
Michelle raised very interestingly, of course, the issue of property, and looking at the index of new homes in the 70 biggest cities in China. I take a deep breath. For 14 months in sequence, the index year on year is negative. In other words, these guys and girls coming up for a year and a half have been seeing the prices of their newly purchased homes going down. Okay, that cannot, long COVID or not, that cannot possibly have a good impact on expectations. Count this up with getting up every morning and feeling dreadful, feeling weak, feeling tired, feeling with pains all over your body, and these are all medically counted symptoms. It's not my imagination, okay? And also having the price of your house going down continuously every month. Yeah, exactly. It's not conducive, okay, to a happy lot. And that includes also Hong Kong. I have to extend this now, of course, to other major big economies. It's no good simply picking up China as a kind of piñata, which is easy to pick. By no means. Okay, neither I have anything against except optimism for China getting better. But that's the situation. Okay.
So, Andrew, what you describe here is a combination of the effects of long COVID, people just feeling dreadful every morning when they go to work. They're seeing their home prices decline month after month, something that they're just not used to in China. This is a pretty serious situation, isn't it, for the economy? How does it get out of that? Because this could go on for a while yet.
There are three things. One is a free admission, that is going to be the case for a lot of people over a long time period. Secondly, I'm sorry, this is not good news. COVID infections go on. The last number I had for Hong Kong, it is nearly about 3 months old now. It was 10,000 cases in a month. That's an enormous amount for Hong Kong. COVID's not away. And in China, I have such obscenely big numbers that I don't want to repeat them because there is no way I can actually prove them. But the WHO, the World Health Organization, clearly continuously clears its throats and says, yes, it's not a pandemic, but it is still infecting a lot of people. And of course, the bigger the size of the country, proportionally, 10% in China is about 100 million people. That's a lot of infections.
And so, Michelle, what is the policy prescription here to try and get the economy back moving again, to offset, what we're seeing in what Andrew describes as long COVID, the declines in the property sector? People are waiting for stimulus, or investors seem to be certainly waiting for stimulus. But what is the right policy response, do you think?
So I think it will be a mixture of different things. For me, I think getting the property sector to stabilize is most important because, in the first quarter, we actually have some decent rebound in the property sales, but it seems that the property sales have already lost momentum in the recent months. And we all know that the property sector, it's 70% of China's total household wealth. So it is very important that we have prices to stabilize. But the tricky situation here is that the policymaker seems to be quite cautious about not to stimulate another bubble. And actually, in the low-tier cities, a lot of the policies have been relaxed. So I think, very likely, the policymakers will roll out further interest rate cuts, further lowering the down payment ratios to stimulate the demand further. But apart from that, I think it's also important for the policymakers to try to revive confidence, especially for the households. And I think what they can do is, for example, to roll out consumption coupons to provide direct income support to the low-income households. These are the things that I think it could be rolled out to support confidence if they do not want to roll out too aggressive measures to stabilize the property sector.
Couldn't agree with Michelle more. Look, inflation in China is less than 1%. It varies between 0 and 1%. They cannot cut interest rates by 50 basis points, by 60 basis points, then by 1.5 basis points. It's completely pointless. It doesn't make any sense. So monetary policy in China is actually caught by the fact that they are blessed, sounds peculiar, they are blessed by incredibly low inflation. They don't have an inflation problem. But they do have absence of aggregate demand. And you cannot address that by cutting interest rates against zero. In other words, interest rates can be cut when inflation is relatively high so that real interest rates are falling. This is a rather pointless exercise in China.
Okay.
Hence fiscal policy. And I love coupons. Michelle, I love coupons. I adore coupons. They are not necessarily the best thing, but it is done. It is quickly. You remember the film? Show me the money. Put the money on the table now. I'm not going to wait for 1 year before I pay a lower income tax. Okay.
Michelle, what do you think about that then? Coupons?
Yes. These things have been done in Hong Kong, in Macau, in Taiwan, and I just don't see the reason why policymakers cannot do it. And I think it is a more ideal measure rather than rolling another. In 2016, the policymakers actually rolled out the Shantytown redevelopment scheme to try to basically provide money for people to buy the houses to support the housing market. I just don't see that they are going to do this again. But if they want to revive confidence by not stimulating the housing sector, I think the consumption coupons will be the more ideal way.
Okay. Andrew, let me ask you about a couple of these geopolitical issues and what their impacts are going to be. First of all, the trade bans, supply chain problems seem to be escalating. China's retaliating to the US by banning or banning without a license anyway the export of two elements which are crucial to semiconductors, gallium and germanium. China produces more than 95% of the global gallium output and 67% of germanium production. What's the impact of this going to be?
Alternative sources of supply. One, massive expenditures on research so that you don't necessarily use rare earths, in the production of batteries, and the realization, the wake-up call that economic warfare has always been with us, will always be with us, and there is absolutely nothing new in what's happening between the United States and China right now. Okay, there used to be the same things. People have got incredibly short memories, possibly because they're very young, and therefore their memories are by necessity short. Okay, the continuous fighting between the United States and Japan back in the 70s. I mean, they just did anything. The time when Japan finally bought Sony and bought Rockefeller Center, nearly the United States went to war with them. In other words, it is a real issue, and I'm afraid it leaves me completely unplushed. Okay, yeah, that's the way it is. The United States will stop sending microchips to China because this can be integrated into defense/offense uses. Yeah, and the United States is not going to arm its opponent in inverted commas, and China, of course, will say, you didn't give us the chips, now you won't be able to produce any chips at all. Never mind giving them to us. Okay. Mm-hmm. Ta-da! Slightly childish, but effective.
Michelle, what do you think is the impact, the economic impact of this? Clearly, it's going to drive up prices, isn't it? Which presumably will then make it more interesting for other countries to step into the fray and start producing these elements themselves.
Yeah, I think it seems that with this export control, Japan, Germany, and Netherlands are the three economies that are most affected because they are the three largest importers of gallium. So I think it's interesting to see that actually before the Japan and Netherlands are actually under pressure of the US government to place limits on the exports of the chip manufacturing equipment. And now that it seems that they are trying to comply with the US policy, so China is trying to fight back. And I think it's just I agree with Andrew that it is the warfare between the U.S. and China is just I think it's just here to stay. It's not going to reverse anytime soon, and it is possible that the situation could get worse with the U.S. election coming next year, because we all know that the anti-China sentiment seems to be quite widespread among the voters in the U.S. So it's just that some uncertainty, the shock that I think the financial markets need to live with, and that's also I think slightly inflationary.
Okay, Andrew, you mentioned earlier Hong Kong, so let me get more thoughts from you about Hong Kong. We had the PMI, it remained in expansion in June, but the weakest expansion in the last 6 months. The Hong Kong PMI declined to 50.3. That's just above the level that separates expansion from contraction. We also had retail sales data this week. Retail sales rose 18.4% from a year earlier. That compares with 14.9% in April and almost 41% growth in March. Where is the Hong Kong economy in the bigger picture?
Well, let me wear very quickly my academic hat. I was a professor of economics for 22 years, and if I had them in front of me for 101 economics, they are not going to pass. Look, May, went up 18.4%. You know what? May a year before, it shrunk by 1.6%. In other words, we have a low base effect. Can you please say that when you give these big fat numbers? Also, you heard it here for the first time. June, July, August and September 22 were all negative to zero. So in other words, I give you a guarantee that the sales numbers for June, July, August and September in Hong Kong are going to be nice, fat, big and strong on the basis of very low basis. There you go.
But where is the Hong Kong economy, though? Obviously, you've got this base effect, but where do you think the economy is now at the moment?
There are two issues here. First, in the case of Hong Kong, it is absolutely impossible to work out meaningfully what exports exports are doing to GDP, because Hong Kong doesn't export anything. 95% of all our exports are re-exports. And there are figures in which can tell you something about the value added of re-exports. But my very back of an envelope calculation is don't take a deep breath and wait on those. Consumption and investment. Now, investment in Hong Kong, of course, is primarily on the property side, and consumption is driven partially, but not fully, by tourism. And tourism, right now, it is not anywhere even near what it was, before COVID. We had very good numbers for April, which gave us an annualized value of tourist visits of about 20 to 25 million at its peak, at its best years. Back in 16, 17, 18, there were nearly 60 million of tourists. We're not anywhere near there. So all these are impacting. More tourists, please. Yeah, but they are coming from China, and they are not coming to Hong Kong. They are visiting China. I was looking at the tourist spending in China during the last 6 months, and there's been a very significant increase to domestic tourism, which makes a lot of sense. People don't want to spend their money. So in the case of Hong Kong, not a great deal can be done. I'm sorry, we're a little bit stuck in mud because, of course, the big engine next door to us is likewise. We can't blame everybody else for that. And Hong Kong is not 100% dependent on China, but if it is 80% dependent on China, that's enough.
Okay. Michelle, what are your thoughts about the Hong Kong economy?
I'm more concerned about the structural side of Hong Kong, because we just talked about how the US China are going to have a long-term conflict, and that's certainly not helpful for the position of Hong Kong as a financial center or the connector with China and the rest of the world in the financing front. I know the Hong Kong government have been trying to do a lot of initiatives to try to promote to be a connector between the Middle East and China, but I think that remains to be seen whether it will yield any success. And also, to me, it's that in Hong Kong, it's just the major advantage is the financial sector. And if you look at the news in mainland China recently, they have actually, first of all, not to mention that now a lot of the banks are trying to find people because the IPO market is just dead, and the stock market trading volume is also not very have not reached their ideal levels because of the weak market sentiment, and that's one. And second, I think under the common prosperity drive in China, you've seen news about the salary cuts in some of the state-owned firms, the security firms. So I think it's just under this long-term policy from the Chinese policymakers that they're trying to encourage more financial resources and talent to flow into the tech sector rather than the financial sector. I think that will also undermine the Hong Kong's position. Like, if the importance of financial sector is less important compared to tech, then I would wonder how much upside that's going to be for the Hong Kong on a structural basis.
Okay. Finally, I want to get a quick comment from you both on the Fed minutes. If you look at the minutes, it looks like Fed officials have done a deal amongst themselves. They'll pause in June, but they're going to raise rates again in July. Andrew, I'm still baffled by what it is that the Fed was waiting to see during this very brief pause. They say they want to assess the impact of the last sort of 10 rate hikes on the economy. Is, first of all, 1 month enough time to do that? And have they learnt anything about the impact of those last 10 rate hikes during this pause?
Not really, except we're having one nice sign, and that is inflation is now 4% and interest rates are 5%. So for a change, we are having real increases in interest rates and not negative, in real levels as opposed to negative. And that's encouraging. But that is very, very metaphysical. In other words, people don't go around saying, oh, good grief, real interest rates are falling, let me spend more. It doesn't work like that. It works in a very subterfugial ways. What the Fed was expecting, I have no idea, I must admit. And the obsession of sticking with job creation numbers in the past had a terrible reputation of really catching you very, very unaware. In other words, there were very big increases or decreases that were unexplainable at the time. That's why I look at the unemployment, I look at the job figures, and I would say, well, they prefer not to make mistakes again by not increasing. All right, I'm not saying not make mistakes again by cutting, by not increasing, and thereby keeping their powder dry. Answer is they are waiting for Godot. Okay, but any economics Godot. I'm being a little bit superstitious here.
Who isn't going to arrive?
They're being
of course.
careful. They're being careful. Yeah.
Okay, Michelle. It looks like we've got to prepare for more rate hikes, though, doesn't it? Certainly another two, quite possibly, according to the minutes.
Yes, I agreed. It's quite likely that in the July we will have another 25 basis point rate hike. But of course, we also need to see what's going to happen with the payroll numbers that will be coming soon. Our expectation is that it will probably remain quite strong. So in line with the trend that what we've seen so far. Yeah, I think we just need to prepare for upside surprise. But I think the good news is that on the inflation front, of course, the PCE data suggested that inflation momentum seems to be coming down. And also, I think if you look at the wage growth in the U.S. economy, there are also signs of softening. It has not fallen to the level that would be consistent with inflation at 2%, but there are some signs of softening, and the job openings are also falling. So if that the overheating of the labor market could be easing without putting a lot of pressure on consumption and the overall economy, then I think that would be good news for a soft landing.
Okay, well, thank you both very much. You heard there Michelle Lam, who is Greater China Economist at Societe Generale Corporate and Investment Banking, and Andrew Freris, the CEO of Ecognosis Advisory.
Peter Lewis's Money Talk.
I'm joined now by Francis Chung, who is the Executive Chairman of MPF Ratings. Morning, Francis.
Good morning.
We've talked a lot over the last few days about the first half performance in the markets. Big outperformance in the US with the Nasdaq up around 30%. Not bad performance either in some Asian markets, particularly Japan and India, but terrible performance in the Chinese markets. Has that been reflected in the MPF performance over the first half of the year?
Yeah, it has. I mean, it's been interesting because on the face of it, I think sort of MPF outcomes in the first 6 months have been reasonable. Just over 60 billion Hong Kong dollars has been added to MPF assets. But in a recent press release we put out, we did ask the question, could it have been more? And it certainly could have been, because the dispersion between US equities and Hong Kong China equities within MPF, I think in the first six months of 2023 was about 20.5%. So it's quite a wide dispersion. And whilst that's significant, the other point that needs to be borne out is that Hong Kong China equities is MPF's biggest asset class. So essentially, if Hong Kong China equities as an asset class does well, MPF members do extremely well. But still, 16.5 billion Hong Kong dollars in total gain is not too bad.
And what was the average performance for MPF funds over the first half of the year?
Average MPF gains were just over 3%. So if you break it down, half of the $60.5 billion that went into MPF was contributions, and the other half were investment gains.
But what about if you look at, say, US markets and then China and Hong Kong-based MPFs? I imagine big difference there.
Big difference. As I said, I mean, I think US equity funds on the average were up about 16%, and for the year, Hong Kong China equity funds were down just over 4.5%.
And I presume this is because of the home bias. Obviously, this is a Hong Kong scheme, so people tend to invest in the local markets.
Yeah, I mean, look, there is a home bias, but I think it would be remiss of me to not say that the MPFA mandated DIS schemes, which are the default schemes that members go into should they not choose, they have less of a bias towards Hong Kong China equities and actually a higher relative allocation to to US equities for one. And as a result, on a diversified basis, those DIS funds, the core accumulation fund in particular, did very well. And as a category, was the best performing diversified fund category this year.
So explain for maybe those listeners who aren't clear about what the default fund is, what this DIS fund is. Explain how that works.
Yeah, or how it doesn't work. And I say that tongue-in-cheek insofar as if MPF members or active Hong Kong workers who have an MPF account don't have the ability to choose a fund based on their personal needs, they will default automatically into the MPF scheme of their employer's choosing, into their default scheme.
Right.
And those default schemes have very, very prescribed investment guidelines. They're well diversified. As I said, they have a higher relative exposure to developed equities than Hong Kong China equities. But not only that, not only those guidelines are sort of well defined, but the fees are capped, and they're capped at 1% total expense. So you do actually get extremely good value for money out of those DIS funds.
And it also highlights, I suppose, a very good investment principle overall, which is the importance of diversification, because this is a diversified fund, isn't it? And then you find that you don't suffer so much if you happen to be in the wrong market or the wrong sector.
Absolutely. I mean, that's probably the core, or that is the core message of MPF Ratings when we provide research, views and education to the marketplace, is that, look, at the end of the day, MPF is for your retirement. It's a long-term investment. Trying to pick and choose markets is extremely difficult. I mean, even in the US, I mean, year to date, a lot of it's been driven by the NASDAQ. So you've got to make that active decision. But if you're unable to make that active decision, time is your best friend, and diversification, it takes away that angst of trying to pick the right market.
And also, people tend to get it wrong, don't they? They tend to panic when the market has gone down, and like maybe they're seeing in Hong Kong and China and say, oh, I really ought to get out. And then also, likewise, they buy into the markets that have had a huge run, sometimes near the top.
No, that's exactly right. I mean, there is that aspect where market timing is just done wrong because there's an emotional aspect to investing. And in fact, each quarter we undertake fund flow analysis within MPF, and consistently what we see is that there is this sort of lagged relationship between market returns and fund trends, where members end up trying to chase markets, and clearly that's not a great way to invest for the long term.
And people, I suppose, should also realise that you've got many years normally until your retirement. A lot of people who are listening are starting out young, saving when they're young. Even if you've got it wrong this year, or the market you happen to be in didn't work out, there are many years, aren't there, for this to work out going forward. So people shouldn't panic. I
mean, absolutely. I mean, I think the average employment or years to retirement for a Hong Kong worker is just over 20 years. So, I mean, think about it. It's a 20-year investment. So, diversification, investing for growth, but being diversified is an important aspect. And again, I would say that with the DIS funds, there are two aspects. There's the core accumulation fund, and there's the age 65. So, and as you get over 50 years old, it slowly allocates more to the more conservative as you approach investing. So not only do you have to not worry about the diversification aspect, but actually the de-risking as you get closer to retirement is also taken care for you. But it's a good point that, look, it is a long-term investment, not only because it is about investing, but by virtue of the fact that you have on average 20-25 years before you retire as a Hong Kong worker, it makes sense to focus on the long term.
So this DIS core accumulation fund, in terms of performance, it's never going to be the best performer, is it? But it's never going to be the worst either under normal circumstances. No.
And again, I think in my most recent press release, I sort of made that point. And as much as there's always sort of that pressure on us when we're asked as so-called independent experts, well, where would you put your money? I mean, it's a very difficult decision to make, and that's why diversification is important. And it's not about picking the best market. It's quite often about avoiding the worst performing asset classes. So it's all about investing for the long term and being consistently invested.
And also, as you just say, actually being invested. The worst thing you can do is not being invested, being out of the market, because you try and time it and you think, oh, there's a better opportunity coming up. And then, it's often the case that, the performance in a year happens on maybe just 10 trading days a year, most of that performance. You happen to miss it, you're wrong to be out of the market.
Absolutely.
Does every MPF scheme have to have one of these DIS funds?
Yeah, it's mandated by the MPFA that every scheme must have an offering, and the fees must be capped at total expense of less than 1%.
Okay, so really people who are listening, they should look at these funds and at least consider them as part of the, their investment sort of profile maybe.
Yeah, I mean, look, personally speaking, I know that I have an allocation to DIS within my MPF exposure. But that was a conscious decision, notwithstanding that it was initially designed for members who felt they were unable to make a decision, that their monies would default automatically. You can make a proactive decision to have DIS as your MPF fund.
Okay. Now, what about going forward? Obviously, this is the first 6 months of the year. Very stark, as you say, dispersion between the different markets. It looks like, from what we've just seen today anyway, and from the Fed minutes, interest rates are going to carry on going up, at least another 2 interest rate rises. This is going to have a substantial impact on Hong Kong, probably.
Yeah, look, I think, what we've seen over the past year or two, it's highly unlikely that environment is going to change. I think at the end of the day, central governments around the world are still focused on fighting inflation, managing growth, and if that means that interest rates either remain at these elevated levels or continue to rise for some time, I think that's kind of the expectation that MPF members should have. But again, I think the point to emphasize here is that from an MPF member perspective, you could almost suggest that this is noise in the market because it's what's happening today. But as you had mentioned earlier, MPF is a long-term investment. It's for your working life and beyond. So whilst it may be an issue today, it's not necessarily going to be an issue that one is going to be looking at in a decade or 2 decades out. And it goes back to what we had talked about earlier, which is time in market, being well diversified, and just ensuring that the funds that you're invested in actually are going to meet your long-term needs, either in the pre-retirement environment or, more importantly, in your post-retirement environment.
Are any changes envisaged for the MPF scheme going forward?
Now, that's a very good question. So, there has been talk about either raising contributions or raising the MPF cap, and I suspect that something will happen to ensure that more money goes into MPF, because at the end of the day, you've got to make sure that average account balances are substantial enough for it to provide a meaningful retirement income for MPF members. So I suspect that something will happen there, and it should, and I think that would be a positive message to the market. There are probably 2 other things that are very interesting in the market at the moment within the MPF system. One is sort of the focus now on value for money. Historically, the MPFA has always sort of justified the performance of the system based on real rates of return. That language we've seen has pivoted to what we have always described MPF as, which is it delivering value for money to members?
Right.
So I think that's the second aspect. There's going to be a greater focus on delivering value to MPF members. So that means just a better member experience from MPF schemes. And then I think the third thing that you will see, and we have seen it recently, and when I say recently, just in the past month, we've seen Manulife and Sun Life launch ESG-focused funds within their scheme offerings. And I think you will see between now and the end of the year, and certainly into 2024, greater emphasis on sustainable investing, and the result of that conversation we'll see sort of new fund launches, and that sort of broadens out the product offering, and arguably sort of improves the member experience because it gives them sort of choice if that's something that they're interested in, sustainable investing, as a possible option to choose.
The reality is, though, isn't it? We probably don't save enough. Most people don't save enough for their retirement. But of course, you don't have to just have the MPF scheme. You could put money into other sort of funds as well. Have your own investments.
Well, that's exactly right. I mean, look, there's always going to be a question based on current contribution rates whether MPF is going to be enough to sustain one's retirement outcome. But I think as it stands now, one should see MPF as just being a component of one's retirement asset. And look, I know from my first-hand experience with my very own children, they're 25, 22 and 18, and the two older ones use the MPF platform's special voluntary contribution option to provide regular savings. There are no fees in, there's no fees out. There's a regular savings that's in, and the only fee they pay is the fund expense ratio of the funds that they invest into. Similarly, for workers who feel they're paying too much in tax, take advantage of the special voluntary of the tax voluntary contribution opportunity. You get you get a tax benefit up to 60,000 Hong Kong dollars of contribution, and so you're basically being paid to save. So there are options out there.
That's a good thing to know. Thank you very much, Francis. It's always a pleasure talking to you. That's Francis Chung, who is Executive Chairman of MPF Ratings. Thank you for listening to Money Talk this morning. You can find more business and finance information from around Asia in my daily newsletter, which is at peterlewismoneytalk.substack.com. On tomorrow's programme, I'm joined by Francis Lun, the CEO of Geo Securities, and Shah, Asia Chief Economist at BBVA. And with a view from Australia is Toby Lawson, the CEO of Staten Partners. Bye for now.
Money Talk